Good morning and welcome to this Tuesday, November 7th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. And I want to welcome you to today's Trading Places Live. Such a pleasure to be with you Tuesdays through Thursdays, especially in this kind of a market. It's been kind of crazy. I've been emphasizing patience to our members. And now you know why. For the last 6-7 trading days, you can see the market now beginning to gain some steam, moving back to the upside. Still got a lot of work to do. Yesterday, in particular, the small cap IWM, Russell 2000, gave back some of its gains, trying to get back through its 50-day moving average. Actually, I think it was the 20-day moving average. We'll take a look at that chart just a couple minutes in a few minutes. But the IWM certainly is one area of the market that's got a lot more work to do. But even the S&P 500, the NASDAQ, we'll get some tests as the market pulls back. We do have futures down a little bit this morning. Let me just quickly give you those numbers. Right now we've got, and I like to look at the ETFs that track the major indices before the market opens over at StockCharts. So if you take a look right now, we got the diamonds, which track the Dow Jones Industrial Average. They're down about almost 0.2%. You've got the spider. That's down about 0.1%. Then we've got the QQQ, which tracks the NASDAQ 100. That's up about 0.1%. But the IWM, which had the week Monday, week opening to this week, the IWM is down about a little bit more than 0.1%. So looking to get off to maybe a little bit of a rough start there. But the futures are bifurcated, meaning that they're mixed. We've got the NASDAQ looking to go higher again today. It has been, number of days now. Let's see, NASDAQ, pulling up the NASDAQ 100. We've had 7 straight days of gains. Friday, we gapped up, kind of held on to it. It wasn't overall a very strong day, but we did finish higher on the NASDAQ 100. And since then, we've had 6 hollow candles where we have closed above the open. And so we've seen some pretty good action. Let's see, I believe the AD line has been jumping back up again. In fact, as you take a look at the action from Monday, you can see the NASDAQ. Look at the AD line jumping back up. This has been a little different than what we've been seeing over the course of the past few months during this downtrend, as the AD line continued to just drift and drift and drift. Never really got a big move back to the upside, but we are seeing that, especially here on the NASDAQ, taking out this double top. Pretty good action. Before we go any further, though, let me want to take a look at 10-year Treasury yield and give you information there, because we are down 5 basis points this morning. So we're down to 4.61% there. We'll take a look at that chart in just a minute. Crude oil down about $1.35 this morning, below 79.50. So after being up in the 80s for a while, we are pulling back on crude oil, getting back down into the upper 70s. That could help in terms of some of the inflation fears that are out there. Personally, I think the market is discounting inflation at this point. And that may be one of the reasons why we're seeing the market doing what it's doing in terms of rising and the 10-year Treasury yield falling. But let's take a look at these numbers here on the Dow Jones. Starting here, 34 points up on Monday. That was, that's the second day now back up above that 50-day moving average. That's good news. S&P 500 up 7.6 points, back above the 50-day moving average again for that second day. That's good news. NASDAQ up 55 points. That's about 1/3 of 1%. So pretty good news there, back above both moving averages. Notice the 20 days on these charts are all turning back up again now. So we now have a rising 20-day moving average. We're back above both moving averages. So what that tells me from a trading perspective, if I'm believing that this is bullish, which I do, I've been waiting for this. It said we'd have a strong end to the fourth quarter. I think this is starting it. What I want to see now is on a pullback, I'd like to see those rising 20-day moving averages hold. So it's not like I believe the market's going to go up every day. I think we'll certainly have some pullbacks, but do we pull back and hold the rising 20-day? Mid caps, you can see right up to the 50, not able to break through yet and pulling back from it yesterday. We did lose almost 1% on the mid caps. Small caps, same thing, except we're down a little bit more, 1.25%. Again, right at that 50-day moving average on on Friday. Last week, we had that big week, got right up to the 50. And then yesterday, we started off with negative movement back to the downside. The transports moving up, getting through the 20-day moving average last week, pulling back yesterday, finishing at 14,502, which is still about 140 points or so above the 20-day moving average. So we got a little bit of cushion now in the market on any pullback. Let's watch those rising 20-day moving averages. If we go back down, move a little bit below the 20 and then right back up, we're fine. What I don't want to see is a move back down below the 20 and see it linger there for multiple days below the 20. I really would like to see any 20-day test. I'd like to see a recovery pretty quickly off of that. So again, this move up last week and even yesterday has given us some room on our major indices down to the 20-day, that rising 20-day moving average, and in an uptrend, if that's what we're in, that rising 20-day moving average should provide us some pretty good support. Let's see, healthcare moving up yesterday. That was our top performing sector. Rose about 2/3%, got back up through the 20-day moving average, which was good. That 20-day moving average currently sitting at 127.34. The XLV finished at 128.26, almost a full dollar above that. Look at technology, and this is one of the reasons why we're seeing the NASDAQ in particular lead this push back to the upside. Technology up about 2/3% as well. And even though it's just challenging its recent high, and even though it's still a little bit below the high we saw at the beginning of September, check out the AD line, which has now eclipsed both of those highs. So I see accumulation taking place, and I talked about this during the downtrend. One of the big differences between the downtrend this summer, which to some degree we talked about back in July, how historically it was a bearish period and we'd have to see, but we wanted to be cautious because of a number of things, negative divergence, seasonality, some of the sentiment indicators turned a little bit bullish, which of course, that's a contrarian indicator. So we had some issues going in the middle of July, toward the end of July, that we had to deal with. We've dealt with them. Unfortunately, it was a correction. When these warning signs come up, it's very difficult to tell whether it's just going to be 1%, 2%, 3%, or whether it's going to be 10%. But you do have to be cautious going into it and recognize that we're in a different period. That's what we went through. But a lot of folks, especially if you're watching media, you're going to get the same old. Oh, we're going down. It's a downtrend. It's a bear market. We're just going, you know where we're going. Anyway, you got to look at what's taking place under the surface of the market. When the stock market is going to go into an extended downtrend, it just makes common sense that money is going to rotate out of aggressive areas and into more defensive areas. That's like common sense 101 when it comes to the stock market. I mean, obviously, price action, everybody gets caught up in the price action. But if you want to look beyond the price action, look at the key intermarket relationships, those ratios. I can't stress it enough, because if you wonder how I call the market and call it pretty well most of the time, a lot of it stems from taking a look at what's going on under the surface. Is the move to the downside sustainable? And if you looked over the last 3 months, you would say, no, this is not sustainable. Money is rotating it's certainly not rotating away from offense into defense. Offensive or aggressive areas of the market have actually been performing better than the defensive areas during this 3-month decline. That makes no sense in the bear market argument. Wall Street firms, the big firms, they control the action. It's not you and me. The big firms, for their own accounts, for their wealthy clients, for their institutional clients, that's where the money's coming from. Billions and billions and billions and billions of dollars. They've got a lot of MBAs on their staff. Trust me, they're really good at calling the market. We don't have all the information that they have. I can tell you, I'm not as smart as most of those folks, but I can read a chart. I can find out where the money is going. And that's the key when you're looking at the market. You've got to be able to zero in on the probabilities. Again, nothing is a guarantee. I've never said I guarantee you the market's going up or down. I've probably been pretty confident sometimes, but I tend to say there are no guarantees. That's what I typically will say. But the under the surface signals give us probabilities and they help us assess risk. That's the key part of all this. Not about being 100% right or wrong. And when you get to that point where you think that, oh, that was a bad call, this person doesn't know what they're talking about. Listen, everybody's going to get it wrong from time to time. But it does you no good to get bearish and scared every time the market goes down. The stock market, I've gone back and studied over the last 100 years. On my Excel spreadsheet, I have 73 years worth of data. There are plenty of downtrends. There are plenty of corrections. There are plenty of pullbacks. There are plenty of bear markets, cyclical, secular. We're never going to avoid them. They're always going to be out there. But we all have to learn to distinguish what the most likely outcome is when we start to see weakness. And I think that's what we're really good at EarningsBeats. Anyhow, as far as the action from yesterday, the only other thing I had to say here, pharma's leading. So from an industry group perspective, we had the pharma's leading the healthcare group. Pharma's up 1.6%, getting back up above the 20-day moving average. Computer hardware leading technology. Apple had a gap down after its earnings. It's back up above where it was before its earnings came out now. So a big recovery in Apple, heading back close now to the 180s again on Apple. That's taken the computer hardware group up back above both the 20 and the 50-day moving average. Watch this group. If Apple continues to move up, I keep hearing the market, and I'm going to talk about this more later in the show, but I keep hearing folks saying, that it's only 7 stocks, 10 stocks, 7 stocks, 5 stocks leading the market. The first thing, those 5, 7, or 10 stocks on the NASDAQ represent half of the NASDAQ's market cap, half the value. I mean, if they do poorly, the market's going to struggle. If they do well, the market's going to do well. You can ride that argument, only 5 stocks, only 7 stocks. The market's not doing well because only 7 stocks are leading it. Well, I mean, they are the 7 largest companies in the U.S. equity market. And those companies matter because they happen to be the 7 most innovative companies in the world, I would argue. And if those 7 companies go up, the stock market goes up. I don't understand the argument. I mean, first of all, I don't understand that argument. Second of all, as I said last week, if you look back year to date, I did this a week ago, probably more than that now. But if you did this a week ago and looked at the S&P 500, 189 companies are beating the S&P 500 this year. 189 out of the 500. It's not 7. Sorry for going on a rant, but I get so sick of hearing misinformation in the market. 189 S&P 500 companies are beating the S&P 500. So if you're saying it's only these 7 companies, you're dead wrong. I mean, that is a false statement. Sorry. Just calling it. I follow the market all the time. Let's put the real news out there. Anyway, gambling also really strong move on Monday. It broke back out on Friday above the 50-day moving average. It continued that yesterday. So good move there. That's part of the consumer discretionary group. All right, moving on. I spent a long time there, so I'm going to try to move through some of these other charts pretty quickly. Let's get a quick update. One thing I'll mention is there are hardly any economic news or reports out this week. I think we have initial jobless claims on Thursday and consumer sentiment on Friday. Earnings are still piling in, but they're more second-tier companies. Most of the large companies have now reported. I don't know how many of the S&P 500 companies, but a good number of them, especially the ones that really matter with the large market caps, many of those have already reported. And so we're going to start getting maybe lesser companies that are reporting, still big companies. I'm talking about multi-billion market cap companies, but not the Apples and Microsofts and Googles of the world. Okay. So let's see what happens with the 10-year Treasury yield without a whole lot of economic news out. And with, I mean, I'm not sure the bond market really looks too much at earnings reports, but earnings reports will begin to slow now here as we move through the next couple of weeks. But 10-year Treasury yield, what did we talk about 3-4 weeks ago? We were at 5%. And I said at the time, I believe the next move down to 450. 450 to 460, that was the range I provided. Why? Because as the yield went up to 5, we had the PPO moving lower. So we had a lower PPO with a higher yield. That's a negative divergence. And you can use divergences on yields. Yields trade opposite bond prices. So if bond prices are going down, yield's going up. Folks are selling bonds. That's what drives the yield higher. Well, the flip side is people buy bonds. So if you were looking at bonds, the price of bonds when they were going down, let me pull up the TLT. So if you pull up the TLT, which is the bond prices of the 20-year, but look at the lower prices and the higher PPO, positive divergence. The yield, you might think, well, divergences don't apply to the yield because it's not, you don't buy a yield. Well, actually, you do kind of buy a yield or sell a yield because it's opposite, 100% opposite, whatever's going on with bond prices. So prices going down, setting a positive divergence, yields going up, setting a negative divergence. So negative divergence to me means 50-day test, means PPO centerline test. That's what I look for. And so what are we doing? Or what did we do? We went down 50-day test. We're getting close to the centerline test. And as a result, as this occurred, what happened to the stock market? Stock market, everybody's saying, well, it's fretting the higher interest rates. Well, we had a pretty good week last week with rates dropping. So understanding the intermarket relationship, understanding technical analysis, divergences, you put all this stuff together to help build a puzzle about what the market may or may not do, both bond and stock market, in the short term and in the longer term, just different signals. I look at different sentiment signals. I look at different charts. Instead of looking at a daily chart, I'm going to look at a weekly chart. I mean, if we look at a weekly chart, say on the S&P 500 right now, I see on the weekly chart coming all the way down the center line, and we're just starting to turn back up. I mean, there's no momentum at zero. So as we move up, the PPO, weekly PPO, just starting to move back to the upside. This is awesome. Now, what did we have when we went into 2022? Because this is where I was going with some of my discussion earlier. In 2022, as we reached the final high, what did you have on the weekly chart? Negative divergence on a weekly chart. You can see that negative divergence started over the summer, and it continued right up till year end. And then in year end, we started seeing in December of 2021, money rotating away from growth and into defensive areas. Consumer staples outperformed consumer discretionary by 10 percentage points in the month of December 2021. That is what rotation to defense looks like. That all came with longer term signals, all pointing to the likelihood, or at least an increasing probability, of a cyclical bear market, a lengthy bear market, not a correction, not a pullback, but a lengthy cyclical bear market, which is what we ended up getting. I'm telling you, this move down that we've seen, and even this move up, this looks nothing like what we were seeing back then. Here, as we were moving up, PPO was rising. Here we're moving up, PPO is falling. Momentum was dying back in 2021. Momentum just getting started in 2022. I think we're bouncing off the center line. I believe the weekly PPO is going to start taking back off again as prices begin to do the same. We'll see. So on that daily chart, you can see there's the S&P 500 getting back up above both moving averages. So as I mentioned earlier, we've got some overhead price resistance. Need to get through 4,400. We're not far away. I mean, if the S&P 500 breaks above 4,400, it's not even, I mean, we want to get a definitive breakout, but the high is 43.93.57, if you want to take it down to the decimal point. 43.93.57. That was the high on the bounce that we had October 1st to the 15th, first half of October. Then we had the big down move, and now we are getting this big rally again back to the upside. Can we take out that 43.93.57? Because once we do, this downtrend, lower low, lower high, lower low, lower high, lower low, is over. It ends when we take out 43.93.57. So keep the number in mind. I believe it's just a matter of time, especially with all the other signals that I like to use, those intermarket relationships. They are not telling me that this market's going lower. I'm sorry, but Wall Street would be bailing. If you look back to see what was going on, throughout this period, we had decent relative ratios, many of them going up. The QQQ versus the spider and many of our growth ratios, as we kept putting in lower lows and lower highs, they were putting in higher highs and higher lows, going the opposite way. How does that happen? Wall Street taking advantage of you, of me, or anybody else that believes that this is going to be a long-term bear market, that all this selling, we're never going to rebound. The market's in trouble and we're going to go down for years. And good God, we're going to go below the 2021 lows. We're taking out the pandemic lows. We might even go to zero. That's what some people want to try to sell you. I'm going to sell you the opposite. How about all-time highs coming later, either in this quarter or the fourth quarter or first quarter of 2024? That's what I see coming. We'll see. Let's see who wins. Anyway, let me go back. I want to show you one more thing on that weekly chart, because when we were going down here in 2021, I want you to go back and look at what was going on with technology and consumer discretionary and communication services, the three most aggressive groups. They were getting slaughtered. There was no relative strength in those groups. They were going down faster than everything else. In fact, during this secular or cyclical bear market, if you look at the XLP, do you see how the money rotated into consumer staples? I mean, honestly, what bear market? If you moved your money into defense like Wall Street was doing, you wouldn't have lost money in the stock market in 2022. XLP was actually in November was up for the year to date. How's that possible? We were down 28% on the S&P 500. Money rotated. When money rotates, you want to follow it. You want to know where Wall Street is putting their money. And I don't look at it so much on a day-to-day basis. You got to kind of look at it on a big picture. Otherwise, you'll drive yourself crazy. I'll get questions. Tom, market went up, but consumer staples led. So does that mean we're done? It's one day. No, we're not done. We will see days where we get leadership, even weeks. Sometimes maybe months, but months are starting to stretch a little bit. The market's going up strong. You want to see leadership in offense. NASDAQ 100 also trying to take out that mid-October high. That's going to be somewhere around that 15.3 level. IWM, this was the one that yesterday had the struggle. And I was trying to think at the chart. Was it the 20-day or the 50-day? It was 50-day, clearly. After the big day on Friday, we went through the 20-day like a hot knife through butter. Got right up to the 50-day, though, and the mid-October highs that we're looking at here are going to be closer to 177, 177.50. So the IWM has more work to do. We haven't gotten through the 50 yet, and then we've still got to take out some pretty important highs on the IWM closer to the 177 level. Transport's still in a downtrend, but nice recovery off of some key long-term support going back over the last year. Got back through the 20. And the one thing I really liked on transports yesterday was look at the intraday move. Where did it go down to? Just below the 20-day moving average. And then what happened? Buyers came in. That's what I want to see on the major indices if we get pullbacks. I want to see buyers come in at the 20-day. All right, EarningsBeats. Here you can see you can start a 30-day trial to our paid service. This would be an absolutely great time to start a trial just because it's in the month of November. This is a bullish month for the market. I've got a lot of positive things to talk about, and I'll be following all the action for all of our members. I do a daily market report every day. I provide so many chart lists of potential trading candidates as we go higher. I think all of that's really going to come into play now that we've got the correction behind us. 30-day free trial. We will reach out to you before the end of your 30-day free trial to let you know your trial is coming to an end. We don't want to charge you if you don't want to be part of our service. Scrolling down at EarningsBeats, you can see if you want to kind of learn more about what we do, you're not quite ready to pull the trigger on the paid service, maybe you can't afford it, just getting started in the market. Hey, I was in that same position 40 years ago trying to figure my way through the market. I lost a lot of money early in my career, not really understanding the market, trying to trade, which was somewhat of a mistake, especially with $150 commissions, $200 commissions going in and out. For those of you who are younger and don't realize, we did used to have to pay a lot of money. It's kind of like buying a house in terms of the commission that you have to pay. I mean, it was ridiculous. But anyway, we're in a much better market now. Learn now about the future, about the stock market. Trust me, it's going to help. I wish I knew all the things I know now. I wish I knew them 30, 40 years ago, or even 20 years ago. So if you want to learn more about the market, you're just getting going, I really strongly emphasize and recommend that you sign up for our free EarningsBeats Digest. It is free, FREE. I can't do anything more for our community. Name and email address is all it takes. Hit that subscribe button. No credit card. You can unsubscribe at any time. So if you don't feel like you're getting anything out of it, which I highly doubt, but if you think there's no significance, no value, unsubscribe. No questions asked. Anyway, I think it would certainly behoove you. Let me move on. Well, here I want to point out that I have written a two-part series. It's the first part is free. It's a free PDF. It's like a book with lots of charts, lots of visual information about how the stock market trades. I'm going to show you a chart in a minute that if anybody followed what I think is the most significant seasonal period of the year, if you followed history, you just made out like a bandit. I'm going to show you the chart in a minute. But in the meantime, get this information. I'm giving away part one free. Go to bowleytrend.earningsbeats.com. Tyler is putting it, or maybe it has already put it, in the comment section. It's in there a few times. Can't miss it. Click on that link and get this report. Name, email. It's all it takes. Click on that download free Bowley Trend Part 1 report. I'm telling you, I don't buy and sell necessarily just on these trends, but I am aware of these trends every single day of the stock market. I know trends inside and out, and it helps immensely in my trading. So this is a step to better your trading. I promise you. Name, email address, hit that Bowley Trend Part 1 report, download it for free. Part 2 is really crazy, but just get Part 1. Start with Part 1, and then we'll talk more about Part 2. By the way, Part 2 was the main reason I got into NVIDIA a week ago. I'm absolutely crushing NVIDIA right now. But it was a historical trend. But anyway, check out these numbers. The first part's free. You got to check that out. Taking a look at the S&P 500. So this was our chart of the day that we actually issued yesterday. And I want to bring this up. I could have given you another one for today, but I wanted to bring this up because it was so powerful. I have said for the last few weeks, you've been watching my shows, you've been getting the daily market report, whatever, anything you've seen. I think I wrote a StockCharts article about it. I think I wrote an article. Let's go back. Let me see, because I want to show you this article I wrote. Perfect timing. So if you go over StockCharts, and go into articles and then hit that drop down menu I just hit. You can go down and read, Trading Places with Tom Bowley. I've got my own blog at StockCharts. I try to write once a week in here, but here, October 22nd. Now let's go back and look at this chart again. Let me show you. Here's October 23rd, okay? 23rd through the 27th was this week, shaded in red. Let's take a look at what I wrote about. Odds favor further selling this week, maybe a lot of it. Talked about the history of the VIX and what the VIX trips are doing. Bearish technical price action, still in a downtrend. And then I talked about historical bearishness. And again, this type of information is the type of information that I try to share in that Bowley Trend Part 1 series. But understanding the calendar is so important. This is since 1950, going back 73 years on the S&P 500. Here is your annualized returns of each of these calendar days. And you can go back and look at it. I'm not going to read them. And then October 27th, it's like the bulls are having a coming out party. I mean, right after the 27th close, look at the, well, I didn't put the numbers in here, but I'll show you those, the results in just a minute. Right after the weakness and the current, I said that the current secular bull market will return stronger than ever. The track record of these signals has been very strong over the last decade, but really it's been going back for years, many decades. So now let's look at that S&P chart. There's the 23rd to the 27th. There's your historical bearish period, the worst week of the year historically. And look what happened. Market got crushed, went down, hit the bottom of the channel. And then on the 27th, it was a coming out party for the bulls. Look what happened here. We're now 6 days in a row on the S&P, 7 days in a row on the NASDAQ up. That was the most bullish week of the year, seasonally, since 1950. Most bearish week, and then most bullish week. Look what happened. Listen, I don't make this stuff up. I research. We provide the best research to our members out there, in my opinion. Technical research, fundamental research, historical research, sentiment research, whatever you're looking for. We got it. And so, like I said, there is a method to our madness at EarningsBeats. There's a reason why we call the market better than anyone else. I think we have more research and we've done more research than anyone else. And don't get this wrong. Wall Street, the big Wall Street firms call the market really well too. And part of what we do is following we follow what they do. So anyway, be sure to take a look at that free Bowley Trend series, series 1 or part 1. It's going to change the way you look at the market. I promise you. If you don't understand these trends, you're going to be in for a major surprise. All right, I'm about to wrap up. Let's just see what the market is doing. Yeah, we got the NASDAQ up. We got the small caps down. So small caps getting hit pretty good here at the open. But the NASDAQ up, S&P just kind of flat. VIX down around 15. It's been struggling here. Saw it kind of crater into the close yesterday. Up a little bit here to open, but that's because the market's down a little. I don't know, that VIX back down at 15 or below 15. As a bull, I'm loving it. Loving to see that VIX faltering from the low 20s now back down to around 15. That's a very good signal for the market. Yeah, I mean, I think that is about it. Let me go in here and just see what kind of comments people are making. By the way, thank you so much for everyone on live stream and for everybody out there who watches our recordings. Please please like our videos and subscribe to our channel. It helps us. I give a lot of time. This is a free show. I do this Tuesday, Wednesday, Thursday. Write a lot of free blog articles. Got the EB Digest, which is free. I mean, we try to provide a lot of really good information, to everyone. And then obviously we need your support in multiple ways to be able to continue to do what we do for free, and then also what we do for our paying members. But if you can't do anything else, like our videos, subscribe to our channel. Those are things that are really easy and will really help us trying to build our channel and build a community that needs to hear the things that we talk about. So please do that for us, and make sure you go into the comment section and find those links that Tyler provided, and come in and check out those that series. Let's see here. Claude says he's an MBA and I'm as smart as them. Well, I'm not an MBA, so I don't have the letters. I am a CPA, so I've got a 4-year degree. I mean, that'll account for something. And I definitely can I can talk numbers with pretty much anyone. But economics. I wish I had almost had a second major in economics. As I've gotten more and more into the stock market over the years, I love economics. I like the way it all goes together, and seeing how sometimes economics don't always line up with the stock market, which is kind of weird. And I think that's the disconnect for a lot of people. You hear good news and the market goes down. You hear bad news, market goes up, and you just feel like, oh, the stock market's crooked. Well, I'm here to tell you it is. In many respects, it is crooked. And that's what we're doing. We're trying to take advantage of the inefficiencies to increase our returns. That's the whole reason that I do what I do. And, I could sit here and, maybe manage money and just not tell anybody the things. But honestly, I'm an educator. I've always been an educator, and I like to provide education. Real estate's looking like a dark horse. Real estate's been beaten down, and of course, commercial real estate with the whole COVID stay at home, employers having problems getting folks come back to work. You may have seen WeWork filed for bankruptcy. That's the office sharing company. I mean, think about it. They went public, I think, in 2019 or 2020. I mean, talk about bad timing to start a business like that. But here they are, going from a $47 billion market cap to bankruptcy. And so there are a lot of commercial real estate properties right now that, go into the cities. There's a lot of vacancies. And, you got banks that are holding that debt. That's why a lot of the banks are not performing well. Small, mid-sized banks that are into commercial real estate, they've got some problems. And we're going to see how it all shakes out. But they definitely have problems. Maybe people go back to work slowly, back in offices. I don't know how it's all going to shake out, but we can watch the charts. So I think right now real estate definitely getting a bounce just because it's been so oversold. But I don't know how much it lasts. We'll see. Transports might not be lifting this morning as hoped. Small caps are down. A lot of times the industrials, transports kind of follow along with the small cap index. So I kind of lump them all together. Industrials usually love the month of November, and here we are. This is the 7th of November, and we still haven't seen any kind of outperformance yet from the industrials. So we'll see whether or not that translates later in the month. Charles, I'm a legend. Yeah, I'm a legend in my own mind, right? Yeah, I'm reading everyone's comments, but I'm going to try to wrap this thing up. All right. What do you think of Yang? I'll just look at one chart here just to wrap this thing up. Let's see what Yang looks like. I'm looking at sideways action here for the last, 8 months, 9 months. I just don't see anything. Not worth trading. This is the China Bear 3x shares. So this is a juiced ETF calling, you're going to benefit when the Chinese market goes down, China market. I'm not a big fan. First of all, it's hard enough to figure out what the heck's going on here in the US for me to try and go into foreign countries. And, the only one that maybe I feel somewhat comfortable talking about is maybe the German DAX. And that's only because the correlation to the S&P 500 is so strong that usually whatever the S&P is doing, the German DAX is doing. So those two kind of go hand in hand. China, this is another thing that killed me when I used to watch CNBC. Is they talk about China and how that's going to impact the U.S. Well, the U.S. market, likely to go down because of China doing this or because of this or that. Do me a favor. Look at the correlation between the China market, the Shanghai, $SSEC, and the S&P 500, $SPX. Pull up correlation. Pull up the S&P 500 and then do the correlation with the SSEC. And go back 20 years and tell me how correlated we are with the China market. That's why I don't pay any attention to CNBC, because a lot of times the information, they are literally just taking information that's being handed to them and speaking into their microphone. They don't do the research. Folks that are delivering the news, I think it's very misleading. I mean, that's the most positive thing I can say, is that it's very misleading. I do not watch it. I'm the worst person to talk about, current events and the stuff going on around the world, because I try to just stick to sports on TV or music or something like that, because I don't want to hear about, I don't want to be skewed. When I was growing up, there was Walter Cronkite. There was some news. I mean, he would tell you if he was going to give his opinion, but basically he was delivering the news. I don't know where you go for news anymore. Anywhere. Nothing is news. Everything's opinion. Everything's clickbait, trying to get more viewers, trying to steal viewers from this other network. And so I don't trust any of the information I get. I trust where Wall Street, the big Wall Street firms, is putting its trillions of dollars. That's what I trust. I got to see it on the chart. If I see it on the chart, I believe it. If I don't see it on the chart, I ignore it. Anyway, that's it. That's my rant for the day. We went way, 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 way over today. Let's get one last quick look at the market. Still pretty much the same. We got small cap still dropping. NASDAQ still kind of hanging in there. VIX still coming back down a little bit, I guess, or maybe it was about the same, right around 15. Anyway, everybody have a great day. I'll be back tomorrow morning for your next Trading Places Live. Remember, Bowley Trend, that Bowley Trend series, that's the common, that's putting together everything that I've studied over the last 73 years. And it really focuses, this particular series focuses more on just this secular bull market, because when you're in a bull market, the numbers are even more eye-popping. You want to check this out, though. Please check that out. Have a great day, everybody. Happy trading.